Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now oil prices were on the climb again, with WTI oil up at $114 per barrel as the drums of war were once again felt across financial markets. Now this followed reports that the European Union was considering imposing an oil embargo on Russia as one option should they further escalate the conflict in Ukraine. There was some disagreement on this course of action, of course. According to several media reports, French President Macron said there would be no taboos in terms of sanctions, though Germany said the move could be premature given already high energy prices, and Bulgaria said it may seek an opt-out given its almost complete dependence on Russian gas. Now, this talk of an embargo followed earlier reports over the weekend that militant groups had attacked Saudi energy facilities, with Saudi Arabia subsequently saying it would not bear responsibility for global oil shortages as a result of these attacks. Now, as investors, there are several ways for us to build some protection against the possibility of still higher oil prices. Energy sector equities are one route, of course, but today I want to talk about the Canadian dollar, or the Loonie. Now, the Loonie has not been just about oil. Canada has faced a continued economic recovery, and rising housing and broader inflationary pressures have meant that the Bank of Canada is likely to raise interest rates. Governor McClem said a couple of weeks ago that the central bank had considerable space to raise rates this year and did not rule out a 50 basis point rate hike. Now, commodity prices, of course, are the other key driver, and the Canadian dollar has, for the most part, shown a positive correlation with oil prices. Now, what has held the Canadian dollar back at times, of course, have been bouts of strength in the US dollar as US rate expectations and risk aversion more broadly have risen. Now, we recently opened a short-term trade that's bullish the Canadian dollar or bearish the USD CAD currency pair. This renewed rise in oil prices has meant that the USD CAD pair has begun to push lower from what was a range trading pattern earlier. And from a technical standpoint, what we find most interesting is the pair's break below support at 1.256. Now this, in our view, means a move towards 1.2445 and then 1.23 is beginning to look increasingly likely. All of this, of course, is part of our broader preference for commodity currencies, which, in our view, looks set to benefit from the current upward pressure on commodity prices more broadly, with the Aussie dollar and the Kiwi dollar being two other commodity currencies that we do currently like, both from a short and a long-term horizon. So please take a look at our daily FX navigator for specific levels. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.